A country can complete 92 space launches in a single year, build some of the most advanced infrastructure on Earth, post 5% GDP growth, and still make its young people feel trapped. That is modern China. On paper, it still looks like a superpower in motion. In real life, millions of people feel like the escalator has stopped. This is the dark side of China. Now, let's be clear, not literally nobody wants to live in China. It is still home to about 1.405 billion people. But something has gone badly wrong when one of the most ambitious societies in modern history is simultaneously dealing with a shrinking population, record low births, falling home prices, weak domestic demand, and a generation of young people that no longer trust the future the way their parents once did. That is not what a healthy rising power looks like. That is what a country looks like when growth is still happening, but belief in the future is not. The most visible crack is the job market, especially for the young. In December 2025, China's urban unemployment rate for 16 to 24-year-olds, excluding students, was 16.5%. That is already ugly. It looks even worse when you remember that the old measure hit 21.3% in June 2023, before publication was suspended and later resumed under a narrower methodology. In other words, even after changing the way the problem was measured, the problem still looked severe. And that matters because this is the exact age group that should be building households, buying homes, and driving the next stage of growth. And the pressure is not going away. China is expected to produce about 12.7 million college graduates in 2026, another record high. So imagine the math: more degrees, more competition, fewer confident employers, weak consumption, a damaged property market. That is not a formula for optimism. It is a formula for delay. Delay marriage, delay children, delay home buying, delay spending, delay life. Once enough people start doing that at the same time, it stops being a personal problem and becomes a macroeconomic one. That is why one of the most revealing numbers in China today is not a GDP number. It is the number of people chasing civil service jobs. For the latest national civil service recruitment cycle, 3.718 million candidates passed initial screening for roughly 38,100 positions. Think about what that says. In a truly dynamic economy, young people are supposed to be excited by new firms, new industries, and rising incomes. In China, millions are sprinting toward the iron rice bowl. They are not chasing upside, they are chasing safety. And when a society starts preferring bureaucratic stability over private sector opportunity on that scale, it is telling you that confidence in the market economy has badly weakened. That is a huge problem because China's private sector is not a side character. It contributes more than 60% of GDP and 80% of urban employment. Yet in 2025, private investment fell 6.4% and foreign direct investment dropped 9.5% to 747.7 billion yuan. Beijing itself felt compelled to pass a private economy promotion law in 2025 to restore confidence. You do not do that when confidence is strong. You do it when the job-creating part of the economy is clearly nervous. And if the part of the economy responsible for most urban jobs is nervous, then young people have every reason to be nervous too. But the deeper wound is not the labor market by itself. The deeper wound is property. For years, Chinese real estate was not just a housing market. It was the country's savings machine, collateral base, middle-class wealth engine, and local government funding model, all rolled into one. Around 70% of household wealth is tied up in real estate, and at its peak, the property sector accounted for roughly a quarter of economic activity. That means apartments in China were never just places to live. They were family strategy. They were retirement backup. They were marriage currency. They were the most important store of security most households had. Then that machine broke. In 2020, Beijing launched the Three Red Lines campaign to curb the debt-fueled expansion of developers. From a financial stability perspective, the logic was understandable. But when a bubble this large starts deflating, there is no painless exit. The result was a prolonged property slump, a wave of developer stress, unfinished projects, and a collapse in trust. In 2025, property investment fell 17.2%, and home sales by floor area dropped 8.7%. By February 2026, official data showed new home prices were still down 3.2% from a year earlier. That is devastating in any economy. In China, where property dominates household wealth, it hits confidence everywhere at once. And the weakness is broad, not isolated. In February 2026, 65 of China's 70 major cities were still posting year-over-year declines in new home prices, while second-hand home prices were falling across all city tiers. Yes, there are occasional monthly upticks in top cities. Yes, Beijing can stabilize parts of the market at the margin, but that is not the same thing as fixing the underlying problem. The underlying problem is that millions of households no longer believe property is a one-way bet, and once that belief goes, the entire psychology of the Chinese middle class changes with it. That is why weak domestic demand sits at the center of this story. The IMF said in February 2026 that domestic demand in China has been subdued, in part because the prolonged property slump and weak social protection have hurt consumers' willingness to spend. China's consumer prices were flat for all of 2025, well below the government's target, a sign that stimulus has done far less for confidence than Beijing wanted. This is the crucial point. A society does not become livable just because factories are busy or exports are strong. It becomes livable when ordinary households feel secure enough to spend, move, and plan. Right now, many Chinese households do not. And if you want proof that the old model is exhausted, look at how China is still growing. In 2025, the country hit 5% GDP growth, largely on the back of exports, while retail sales grew only 3.7%. It also posted a record trade surplus of 1.2 trillion United States dollars. That looks impressive, but it also reveals the imbalance. China is still exceptionally good at producing. It is just much less successful at making households feel comfortable consuming. That is not a small distinction. It is the difference between a country that looks powerful from the outside and a country that feels secure from the inside. Then comes the fiscal side of the crisis. Local governments in China have long relied on land sales for revenue. But in 2025, land sales revenue fell another 14.7%, and total fiscal revenue declined 1.7%, the first drop since 2020. That matters because the same local governments that are supposed to support growth, maintain services, and stabilize confidence were heavily dependent on the very property model that is now failing. So the property crash is not just a housing problem, it is also a local government finance problem. And when local governments get squeezed, public services, wages, investment priorities, and social confidence all come under pressure as well. Beneath all of this is a structural reason households remain cautious. China still does not provide enough security to make people comfortable spending aggressively. The IMF has argued that a stronger social safety net and easier hukou access are essential to shifting the economy toward consumption-led growth. The hukou system still limits many migrant workers' access to full urban benefits, effectively telling millions of people that they can work in the city without fully belonging to it. The IMF estimates that granting urban status to 200 million rural migrants could raise the consumption to GDP ratio by an additional 0.6 percentage points. That is a very elegant way of saying something simple. People save more when they feel unprotected. And then there is demographics, which makes everything worse. In 2025, China's population fell by 3.39 million. Births dropped to 7.92 million, down 17% from 2024, while 23% of the population was already age 60 or above. Marriage registrations had plunged 20% in 2024. In response, Beijing has raised retirement ages, expanded childcare support, and started talking much more aggressively about building a birth-friendly society. But subsidies do not solve the deeper issue. People do not avoid marriage and children simply because diapers are expensive. They avoid them because the future feels insecure. Weak job prospects, falling housing wealth, and a thin safety net do not create baby booms. They create hesitation. And that is what makes this so important. China is not failing because it cannot build. It can. It is not failing because it lacks industrial strength. It does not. It is not even failing because growth has disappeared. It has not. China is struggling because the old social contract is weakening. For years, the implicit deal was simple: study hard, work hard, buy property, get richer, raise a family, move up. But now, the jobs feel less secure, the private sector feels less trusted, the housing market feels less safe, and the cost of family formation feels harder to justify. Once that deal starts breaking, people do not need to become political dissidents to change their behavior. They simply become cautious. And mass caution is deadly for a growth model built on confidence. So when people say, why nobody wants to live in China, the deeper point is not literal depopulation through immigration. The deeper point is that too many people inside China no longer feel confident building their lives there in the way previous generations did. The country still has money, it still has scale, it still has ambition, but livability is not measured by launch counts, trade surpluses, or skyline photos. It is measured by whether ordinary people believe tomorrow will be safer, richer, and more stable than today. Right now, that is China's real crisis, not just slower growth, not just falling property, not just youth unemployment, a crisis of belief. And when a society loses belief, the most dangerous slowdown is not in GDP, it is in life itself.